All right. Good afternoon, good morning, wherever you're logging in from. Hope everybody's having a great day so far. This is going to be probably one of the most important webinars that we have done this year in the MyFit University company. There has been so much change in the tax world, and a lot of questions have been asked about this, and so we wanted to make sure that we get a pretty comprehensive overview, but really take the complexity out of it and try to simplify navigating the new tax laws. Now, if you've ever been a part of a MyFit University webinar before or have been one of our live seminars, you know that we do take a pretty deep dive into this, but our goal is to simplify the process of understanding some of the most complex things in the financial world. So this webinar, again, navigating the new tax law. So just be prepared. This is a tax webinar. We're going to talk a lot about taxes, how it affects you as the federal employee. There are some things that pertain, some things that don't, but really taking a deep dive into what it is, what's changed, and then how can you take advantage of some of the huge opportunities that have been given to all of us, especially you, the federal employee, in the tax world, making your retirement more tax efficient, making sure that you're doing things as tax efficiently while you're working as possible. Those are all things we're going to hit on today, which so I'm excited. And again, my name is Ryan Palomini. I have had the privilege of teaching workshops for MyFed University now for over 5 years. I'm a network representative. I also run a tax and wealth management firm. And so a lot of questions around this new tax law and how it's going to affect you, the federal employee. So let's dive into it. I know federal employees have had a pretty interesting year with all the reduction in forces and the early retirement options and the deferred retirement and all these things. And so you got all that, and I have new tax laws. And how do you start mashing them together, right, and really maximizing everything that we're doing? So a couple of quick disclaimers. I'm going to give general information today. Okay, whatever I say, please just don't take and go and implement it without talking to a financial professional. MyFed University is an education company, so today is about education. Before you make any financial changes, consult with a professional first. Okay. Now, who is MyFed University? And why are we here today? So MyFed University is one of the leading federal education companies in the space. They are a government registered vendor, which means that they have gone through the certification process to be registered with the federal government, to be able to bid on government contracts, teach these workshops all over the United States. And I know there's a lot of noise out there right now, and I think it's important to understand the difference between, some of the other, I guess you can call them federal education companies and legitimate registered vendors. Very big difference, right? There's a huge process that MyFed University goes through to be a government registered vendor, having a SAMS number, DUNS number, cage code, and those are all just parts of going through the process. MyFit University, if you have not been to their website, highly recommend going. There is an incredible amount of content that has been done with previous seminars that you can get access to. And they also have live seminars all over the country. So make sure you go and you check that events tab, because there are vetted network representatives of MyFit University that once again are conducting live seminars in cities all over the United States. So I know that there are probably about 30 to 40 over the next 2 months that are going to be presented all over the country. So if you like the kind of in-person local seminars, please make sure you check the events tab, because there's a lot going on right now. Okay, and also they do regular webinars as well. There'll be several more this year. So again, one of the things that I request from everybody is that I know that you guys are going to have a lot of questions coming in, and I'm going to go through some pretty detailed information on tax planning and how things changed. And what I want you to do is I want you to jot down every specific question you have that pertains to you. I mean, if we didn't have thousands of people on this webinar, I'd be able to take Q&A, but then we don't have time. We're not gonna have time for that today. But I know you're gonna have questions, and I want to make sure that you get every single one of your questions answered. So at the very end of this workshop, what's going to happen is there's going to be a survey that pops up, and and I always tell people this, and what I love about when we do these workshops is everybody is incredibly detailed with the information they put down and what they want to know. So you'll have the opportunity to fill out a form, tell us exactly what questions you want to have answered that pertain to your personal situation, and one of the vetted network representatives will be in touch with you to answer your specific questions. On top of that, they will also do a complimentary financial analysis that tells you what your pension is going to be from the government, your TSP projection, how this new tax law affects your Social Security and all the other things. So be as clear as possible so that they know how to help you. Okay. Um, Now, there's been a lot of change, and there's going to be some things we're going to talk about. What is the big beautiful tax bill? What does it mean for your retirement and your estate plan? And be very clear, estate planning and tax planning go hand in hand. And I get it, it's so important that you understand how this affects you not only while you're here, but when you're no longer here as well, and you're leaving your assets behind for your family. How does it affect you now, and without being sounding morbid, right, at death as well? So what's permanent, what's temporary, and really what is the price, right? Because all these things come with a price. Everything, when we lower taxes, it's got to be paid for somewhere. Where is it being paid for, right? And who's paying the bill for lowering tax liabilities? And we're going to talk through all that. And I want you to understand something. Permanent just means that it's there until somebody changes it. It doesn't mean it's there forever. Okay, that could be, this could be permanent until a new administration comes in and makes changes to it. Okay, so just be clear. There's a lot of gray areas, as you know, in the federal world here. Now, had the tax bill not passed, what would that have looked like, and what does that mean? So these are the 2025 income tax brackets. Now, one of the things that I love about the tax world that we're in. Now, remember, I run a tax practice, and we serve thousands of people all over the United States, especially in the federal world, doing tax planning. And what I love about the tax brackets that we've been in, the tax laws that we've had, and hopefully going forward, the continuation of this, which what it looks like without a whole lot of drastic change, there are so many strategies that you, the federal employee, can take advantage of and implement into your financial plan. Now, I want you to write this down because I think this is incredibly important, and plaster this somewhere where you can see it all the time. And this is when you start thinking about retirement planning and income planning and tax planning. The foundation of every financial plan is a tax plan, right? Taxes, write this one down. Taxes are the foundation of every financial plan. Taxes are the foundation of every financial plan. Look, I've had the privilege of teaching these workshops and work with federal employees now for over 15 years, and from North Carolina all the way to California and beyond. Right, we work with people all over the place, and what always boggles my mind is how many people do not have a tax plan built into their financial plan. Meaning they may have an idea what they want to do with TSP, they have an idea maybe when they want to take Social Security, but they don't know how all the things affect one another. And when you look at these income tax brackets, these play such an important role in making every single decision. I want you to think about your retirement like a puzzle, and your job is to turn those pieces, right, to build that puzzle. But really, when you're doing that, you need to know how to maximize every single piece of that puzzle to maximize your entire retirement, right? And when you build a puzzle, most people always do the borders of that puzzle first. Why? Because the borders represent the foundation of the puzzle and the picture, and then everything else becomes easier and clearer as you put those together. Like, this is nothing different, right? Having an incredible foundation for your retirement and your financial plan is so critical, because then everything else becomes a little bit easier. And understanding how these brackets you see in your screen right here affect you short term and long term are going to play such an important role in your success. So let me explain what I mean. You have these brackets that are 10, 12, 22, 24, 32, 35, 37, right? You have all these different brackets. Now, these are what's called a marginal tax rate. Okay, I'm not going to get too fancy, but this is called the marginal tax rate. And I want you to look at where you fall here. So most people fall between the 22 and the 24% tax bracket. So what that means is that if you are an individual or a single filer and your adjusted gross income is between 48,000 and 103,000, you fall in the 22% tax bracket. That is the highest bracket that you're going to pay into, which I'll explain a little bit as we go. Now, if you're married filing jointly, this is a combined income of anywhere between 96,000 to 206,000 in combined income, puts you and your spouse in a 22% tax bracket. So why is this important? Because if the bill had not passed, we were going to go back to the 2016 tax tables, which means that it would have been a 7.5% overall tax increase for most people. Now, why would that have been? Because right now we are in, and I know it doesn't feel like it all the time, but we're in the lowest tax environment we've ever been in. I know it feels like we're always paying taxes, right? But here's why that is so important, because we have more room between each bracket than we've ever had before. To go from a $48,000 to $103,000 if you're in the individual 22% tax bracket, that is an incredible amount of income opportunity before you go to the next tax bracket, right? Or from 103 to 97,000, then it gets bigger and bigger as you go. And this is going to play an incredibly important role for all of you as you plan for your retirement, because you're going to be able to implement strategies that we're going to talk about later, like, doing Roth TSP, doing things like Roth conversions, utilizing the new tax laws to keep your tax liabilities lower while you're working. So look at this bracket, find where you are, write it down, and we're going to keep diving deeper into there. So here's the thing. The IRS gives us this gift called a standard deduction. And the standard deduction permanently increased. Now, before the standard deduction was so high, more people used to do this thing called itemizing. Now, truthfully, probably only about 20 to 25% of people itemize anymore, because the standard deduction went so high that most people don't have enough write-offs to itemize anymore, unless you're doing big charitable contribution and whatnot. But it's effective in 2025, and it's inflation protection, which means it's going to continue to keep being high. So let's take a look at what that means. You also have this huge increase, which I'm going to talk about the effective tax rate, and I'm also going to talk about standard deduction shortly as I break this down. But one of the other big changes, and this affects all these things, was your estate tax. Now, for most of us, estate taxes, they're not going to really affect too many of us, because look, you can, before you begin paying an estate tax, you can make up to, now this is 2025, and you can see how 2026 increased, for a single person, you could have an estate of $13.99 million before your family pays an estate tax. Now I'm going to explain that in a second shortly. Or a married couple can have up to $27.98 million in their estate passed on to the family before the family pays big estate taxes. Now, that's going to increase in 2026 to 15 million for an individual, 30 million for married couples. That's an incredible inheritance, incredible estate to have to pass on. But I want you to write this down, because this is what throws off so many people. When you look at this, you go, oh, cool, then I can pass all my money on tax-free without any estate taxes. That is incorrect. One of the things that throws so many people off when it comes to this estate tax is not understanding that when you pass away, any money that you have in a traditional, meaning pre-taxed TSP, 401k, IRA, when that gets passed on to your family, that is a taxable event for your family. So this thought of, oh, well, I'm not going to pass on $1 million or $13 million for my TSP, my family is tax-free, that is incorrect. So one of the strategies that you need to make sure you're implementing and you need to know is, if you passed away, what is the actual tax burden for your family. That's why estate planning is so important, because there are so many things that you can do to be sure that when you pass away, you're not leaving this huge tax burden onto your family. Because I want you to think about this. If you have $1 million in your TSP and you were to pass away, and let's say that you pass it on to a spouse. Well, guess what's going to happen? Your spouse is going to be able to take that money over, and they're going to have an inherited IRA, and they're going to be subject to the same tax liabilities you would. They're going to have to worry about the required minimum distribution. They're going to have to pay taxes on the distribution they take out of there. So they don't have a time frame necessarily of when they have to draw that down. However, this is important for everybody that has anybody other than a spouse that is going to inherit your money. What's really important to know is that anybody other than a spouse, so it could be a child, it could be, your brother, your cousin, your parents, whoever, anybody other than a spouse has 10 years to draw down a traditional IRA, pre-tax IRA, deferred IRA, however you want to call it. They have 10 years to pay that down and still pay all the tax on that. So I want to make it clear, because a lot of people get estate taxes and the money that's getting passed to my family mixed up from traditional IRAs. Really important to know the difference on there, and that's something we can help with. So again, for those of you that are jumping on here, at the very end of this workshop, you're going to have the ability to get all of your questions answered. This is a big one that we get a lot of questions on: is what does it look like if I were to pass away? What's the tax burden on my family, and how can I limit that? If that's a question, write it down and we'll make sure we answer it for you with your specific individual need. So I want to hit that, because that's part of estate planning 101. Is yes, we have this great estate tax. Now this is more applied to things that are not in an IRA fashion. It could be real estate, it could be, money being passed down, so on. So there's a lot of different things that fall into estate tax. Traditional IRAs are not one of them. Okay. Now, as a senior, we get a bonus on top of it. So one of the things that excites me about this new tax bill, I'll be honest with you, is for a lot of you that are getting ready to retire, you now have a few additional bonuses. And when I say bonuses, I mean tax deductions, that's going to give you the opportunity to stay in a lower tax bracket, but also do a great amount of tax planning as you retire. Because here's what I know. After 15 years of work with federal employees, I can tell you that most people, now probably about 85% of federal employees, have all of their money, or at least 90% of their money, in traditional TSP. That is the original pre-tax TSP. And that's okay. You've used that to help defer on your taxes while you're working. However, some of the common mistakes that I see from a tax perspective is all of that pre-tax money catches up to a lot of people in retirement, and actually is the number one reason that most people get bumped to the next tax bracket, is because of that pre-tax money that they have to take out of their TSP, maybe sometimes more than what they need to. And that is what I have seen more people get forced to a higher tax bracket and not be able to do anything about it. So having all these new bonuses and new deductions is going to allow you more freedom to be able to do high level tax planning, whether it's doing things like Roth conversions, or really planning on these things for a bigger picture. So here's one thing that was given to us: a $6,000 standard bonus for people who are 65 or older, and that's effective for the next 3 years. And I want to also be very clear for all of you listening: you're going to see this thing where from 2025 to 2028, 25 to 2029, I want to make it very clear, and I would write this down, that you really have a incredibly important 4-year tax planning window. If you have not started tax planning, if you are maybe working with a financial advisor that is not talking about tax planning, you are going to miss out on probably one of the most important windows of your life when it comes to tax planning. Because look, this is a bonus for the next 3 years, okay? this could be an incredible opportunity for you to take advantage of, like I said, Roth conversions, things of that nature, where maybe you didn't have that opportunity before. Because look, there are phase outs for this too. So there's income phase out of, a modified adjusted gross income of above 75 grand for individuals, 150,000 for couples filing jointly. And so again, these are things that you need to know how to take advantage of. Now, let's take a look at how these brackets break down. So here's how you take advantage. These were 2024 versus this year. So, some of you are going, man, it's August. Can I still take advantage of this? Absolutely. There are things that you need to do, but look at what could change drastically for you. So in 2025, the standard deduction of 15,750 for a single filer, most of the time it's around to 15 grand, but so 15,750. Now, an existing deduction, part of the standard deduction is if you were 65 and older, they also gave you, and most people don't even know this, you also had an additional $2,000 standard deduction. So that was nice. You had up to 17,000 plus in standard deduction by being age 65. That helped give you a little more wiggle room and help lower your tax liabilities. But look at this now. Now there's an additional $6,000 for the next few years that you can get. So what did that mean? That meant that the net difference from 2024 to 2025 is a 7,200. That's a huge difference in your ability to save on taxes. Okay, now again, this all goes back to tax planning, but let's look at the married couple filing jointly. What does that do now? So if now again, we're really talking about for seniors 65 and older, but here's what this looks like. Standard deduction for a married couple filing jointly is $31,500 in 2025, what it went up to. Now, the existing, if you were over the age of 65, a married filing jointly couple had a $3,200 in additional standard deduction. And look at this now. Each senior getting an additional $6,000. That's 12 grand for the two of you. So that is a net difference of 14,400 in new tax deductions. That is phenomenal. Now, why is that introduced? Why is that new $6,000 there? Well, one of the things they wanted to do was try to eliminate the ability for people to not pay on their Social Security. And that there was no way that was ever going to get passed. So instead of eliminating Social Security tax, again, what they did was they're giving some bonus taxes. Now, again, that is not permanent. This is for a period of time. So one thing that you want to write down is do not avoid adding in and planning for taxes on your Social Security. Some people go, no, we've got this new tax bill. I'm not worried about tax on Social Security anymore. You need to worry about it. It is still going to come out of your, it's still going to go on your tax return as a taxable income next year on your 1040. That means you need to be prepared for that. You need to withhold taxes on there. Now you may get more back because of these deductions, but do not get it twisted. You are still liable for planning for tax on your Social Security. Okay, really important. Now, again, a lot of you are going to have questions on Social Security and how it's taxed. One of the things that we have the ability to do is really break that down and show you exactly what your tax liabilities are, not only on your pension, but also on your Social Security. So if that's a question you have, write that down so one of our advisors know how to help answer that for you. Because again, part of attending this, you're going to get that report that's going to show you all of your tax liabilities, what to look out for, and how to avoid them, and at least how to be prepared for them. Okay, so write that down as something you want to get some more additional information on. Now, here's a nice breakdown of this so you can see. So let's say you are retired and you are 65 years old and you are making $100,000 a year. And the reason I say retired is because in this example, they're not using 401k to also offset. So let's just, say you're retired in this situation. You're 65 years old, you're making $100,000 a year as a married couple filing jointly. Standard deduction went up to $31,500. Okay, the existing 65 plus deduction is an additional $3,200. And now we have this new senior bonus of $12,000, $6,000 each person. So when you go to file your taxes, your taxable income went from $100,000 all the way down to $53,000. That is an incredible savings, which means now you really truly have the ability to save a ton of money. Now, in that situation, as a married couple filing jointly, you are in a 12% federal tax bracket. It's incredibly low. So that's great news because look, remember, the 12% federal tax bracket for a married couple filing jointly, that goes all the way to 96 grand. So in this situation, you could do some serious tax planning and still stay in the same 12% tax bracket, but to begin to start creating tax-free money for you and your family, okay? So an incredible opportunity. This is why I really I can't emphasize enough my excitement for this new bill, in the sense that for a lot of you, if you truly take advantage of the next 4 to 5 years, you could set yourself up really nice for a very tax efficient retirement. All right, now I'm going to touch on this quickly. This is more of the SALT tax. So this is for those of you that live in high income tax states and also who have high property taxes. The SALT tax went up to $40,000. Now, this is phased out for those of you that have a modified adjusted gross income of over $500,000. Now, this is most of you are going to be able to take advantage of this. It still may not be more than the standard deduction. So as great as this looks, and the SALT tax went up, for those of you in high income, high tax states, this could help you. However, if it's still not surpassing the standard deduction, not going to really do a whole lot, but this could help. So make sure that when you file your taxes, make sure you see if the SALT tax deduction is going to help you or not. Okay. Now, here's a couple temporary provision, and I'm going to hit on this one. I think this was important to put in here because for everybody on here is all different ages. I know we probably have people who are brand new in the federal world. Some of you are either just retired or retiring this year, so all different ages. A lot of you have kids, and some of you have been funding the 529 plan, the UTMA accounts. There's so many different plans you can fund now, but they have this new Trump account for kids savings, and these are tax advantage savings accounts. Now, I do want to be clear. You have in this account, for those you have kids, you have up to $5,000 as a parent that you can contribute to this account every year. Okay. Now, as long as your children meet the criteria is, so again, this is what I'm talking about, another 5-year window. If your child was born after December 31st of 2024, so really this year, right, from January 1st of this year, and before January 1st of 2029, your child will also be eligible. By the way, they have to be a U.S. citizen, have a social security number. They are eligible to receive a one-time government contribution of $1,000. So not bad. So you're gonna have kids, have the next 5 years, so you get $1,000 for them, I guess. But here's the thing. Here's what you do need to know about this. All right, this is why you have to compare these things to a 529 plan, an UTMA account, all these, cash value life insurance, whatever you're using to fund a child's, retirement or college savings. This is not meant to be a college savings account. Now, let me be clear why this is different from a 529 plan, because here's what happens. All the funding that takes place in this new Trump account, kids savings account, whatever you want to call it, when they turn 18, that turns into and is treated like a traditional IRA. This is meant to be a retirement plan for a child, okay? So here's what happens. When your child turns 18, if they were to withdraw money from this account, it's identical to what would happen to you, the federal employee, if you try to withdraw money from your TSP before 59 and a half. You and they would be subject to the 10% early retirement penalty. So if your child at 22 decides to take out $2,000 from this account, they're going to take that out. They're going to be taxed at ordinary income tax, and they are also going to be subject to a 10% penalty withdrawal. Okay, so those are things that you have to know, not penalty free, a penalty on that withdrawal. So that's important. Okay, now again, there's also a tax on auto loan interest for new U.S. assembled vehicles. You got to find out stipulations all those are. It's got to be made here and all, which most cars aren't even made here anymore. So, I don't know how much people are going to take advantage of that, but that is part of this as well. Now, all of this that I just told you about, the last half hour of going, these are all the things that are new, things you can change. What does that mean? That means that in order to pay for this, I want you to think long and hard about this. In order to pay for all of these tax savings, it is projected over the next 10 years that this is going to add $3.8 trillion to our already existing deficit. By the way, we are $36 trillion in debt as a nation. So, is this new tax law and these low tax levels that we're in sustainable? Well, that's a big question, because if these are going to be sustainable, which technically they're really not, where is this going to come from to pay for all this? Now, as for those of you getting ready to retire, or you are planning for your future now, maybe you're starting to do Roth, TSP, or whatever, these are things you need to think about. What is going to happen in the future to fund this stuff? Well, is there going to be reduced future spending? I mean, they're spending like there's no tomorrow right now in the government, right? I mean, you can see all this. We're about to spend and add $3 trillion to our tax deficit. Is there going to be an increase in borrowing? Is the government going to, assign more U.S. Treasury bonds because they have to keep, borrowing from you? Is that going to happen? Are they going to have to increase the revenue on economic growth? Is there going to increase revenue with higher taxes? Again, you have a really important 4 to 5 year window here. After that, I don't know how sustainable this is going to be. Is it going to, 5 years from now, if you're in retirement and all of a sudden things get really, I guess, more expensive than they are today, how are you going to handle that in retirement? What do you have in place to help you sustain that kind of economic uncertainty, right? And those are things that we look at, because here's the thing: as these things rise, as taxes rise, your TSP may be taxed more, your Social Security could be taxed more, your annuity from the government could be taxed at a higher rate. These are all things you have to consider. It's not just about the short term. When you're thinking about tax planning and changes to the tax bills, let's be clear, there is no certainty that this is going to be here. Like I said, it's permanent doesn't mean permanent forever. Permanent means that this is here until somebody makes a change to it. If we have a drastic administrative change, this could drastically change as well. And there's nothing you can do about it. That's called legislative change. And unfortunately, it's one of the things that we have no control over. So when you are thinking about retirement planning and financial planning, you need to take into consideration things you can control, but also think about the things you cannot control, right? And this is one of them. So take advantage of what's in front of you and know that it may not be there forever. So take advantage of why it is there. Because here's the thing: when you have tax deferred accounts, here are some of the things you have to think about. Now, when I say tax deferred, what I'm referring to are traditional TSPs, traditional IRAs, things of that nature. So when you start to take a withdrawal or you start to deduct money from your TSP traditional, every distribution is going to be taxed at your highest rate. And I'll give you an example of what I mean by that in a second. Distributions can lead to, look, here's the thing, regardless if you need to take a distribution, there's this thing, and I would write this down. This is probably one of the most important parts of this entire tax talk. Because when you see this distributions required, whether you need them or not. What that means is that when you turn 73 or you turn 75, there is this thing called the required minimum distribution, or the acronym is RMD. And I would write that down because I'm going to tell you right now, here's what I have found in 15 years of work with federal employees. 63% of our federal clients are in the same tax bracket when they retire than they were while they were working. Now that stat may be disturbing to some of you because your entire career you have been told put money in the tax deferred account, defer, 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 because when you retire, you'll be in a lower tax bracket and you will be able to reap the rewards of the tax savings in your TSP, tax deferred. Does that sound familiar? Here's the problem with that. 63% of you are going to be in the same tax bracket when you retire than you are right now. And there are several reasons for that. Number one, you have a three-legged stool of your retirement, and all three of them are potentially fully taxable. Your FERS annuity or your CSRS CSRS annuity, that's going to be a fully taxable income. Your TSP traditional, every single penny, taxable income. Those two things could lead to your Social Security being taxed. See, this tax thing has a ripple effect on every part of your retirement. And so you have to have every part of your retirement working in harmony with each other. I can't tell you, I have had the privilege of working with thousands of federal employees, doing tax planning for them, doing financial planning. And here's what I have found. I see so many people come to us, and again, they know how they want to take a distribution from TSP, but they don't know what the tax liabilities are going to be are. They know what their FERS annuity is going to be, but they don't know what the real taxes on their FERS annuity. And then they don't understand how those two things are going to drastically affect the tax on your Social Security. And then people retire in their first year of taking Social Security and wonder why they get a big old tax bill because they did not withhold enough or any of their Social Security because they didn't realize that the first two affect the third part, right? You have to build a plan where all of your assets and all these parts are working in harmony with each other. So when the time comes to start taking distributions, there are no surprises. You know exactly how much you're going to be taxed, where it's going to come from, and then there are no surprises on that because these distributions, they can lead to higher tax brackets. Oh, and by the way, talk about being forced to take out money. Most of you are going to be in a position where you're not going to need every dollar of your TSP to live. Your pension, your Social Security, maybe you need some money from your TSP to live on, but a lot of you are going to be in a position where you're going to have a good chunk potentially of your TSP that's going to be there as a nest egg for you, as a safety net. And here's what's going to happen. If you are not taking enough from those traditional accounts at 73 or 75, the IRS is going to knock on your door and they are going to force you to take money whether you need it or not. So think about this for a second. What if you had $500,000 in your TSP and you just need $10,000 a year from your TSP and life has been really good? Meaning like my pension is good, my Social Security is good, and I'm taking 10 grand a year from my TSP as extra income. Maybe that's your vacation money, whatnot. And then all of a sudden, at 73 or 75, the IRS knocks on your door and they say, hey, you've got $500,000 in your traditional IRA. It's time for you to start taking out 20 grand a year. And you go, but I only need 10,000. They're going to say, that's too bad. We need our tax money. We let you defer for 75 years of your life. It's time to pay up. And what do you think that additional 10, 15, 20,000 that they force you to take out, what do you think that that's going to do to your tax bracket? Folks, that's the difference for most people between a 12 and a 22% federal tax bracket. Being forced to do something that you don't need to do or you don't want to do, but you have to. That could lead to higher tax brackets, additional tax on your Social Security, more capital gains tax, because the higher your income, the bigger your capital gains tax could be. And again, higher tax accounts to leave to your heirs. The more that traditional TSP keeps growing and growing and growing, the bigger the tax liability for your family inheriting that. okay? So all these are all things you got to consider. I know they're not easy, but there are a lot of moving parts here. Now, here's an example of a single filer who is making 200,000 and is not taking an IRA distribution. Well, going back to our tax brackets, $200,000 is going to put this person at the highest tax rate of 32%. Now, remember I used the word marginal tax brackets when we first started. I showed you the 10, 12, 22, 24. That's a marginal. Now, you don't pay all the taxes at the highest rate, right? You pay proportionally in each tax bracket, as you can see. So 10% on the first 11,925, a percentage on the 12,000, 22, and you can see that as this grows. Now, what this leads to is this thing called an effective tax rate, and I would write that down because that's really the most important number here, is the effective tax rate. The effective tax rate is if you take all these and you add them all up, it is the average that you are going to pay of all these. So this gentleman in the picture, he is in the 32% tax bracket. However, he is not paying 32% of 200 grand. He's paying a different percentage called the effective tax rate. Okay, that's important for a lot of you to know because that's going to allow you to figure out what you have for tax planning opportunities in the future. Now, let's see what happens if he takes a distribution. So in this situation, he is going to take an IRA distribution this year, and he's going to take a $10,000 distribution. So what happens? Well, that distribution, because it's after his taxable income, right? That's on top of his taxable income, 200 grand plus 10,000. So now that IRA is going to be taxed at his highest 32%. So every 10,000 is going to be an additional 3,200 in taxable income. That plays a big role in the effective tax rate. You have to be prepared. You have to know when I am taking distributions, what is coming from what and where is it coming from and how much is it going to add? Because that 3,200 in additional tax could potentially raise your effective tax rate to a higher level. I know it's confusing, but we have software that'll show you exactly what I'm talking about. But these are things that, listen, if you are not talking about this, if this is not built in a part of your financial plan, whether you're doing it by yourself, you have an advisor, these are the details that can really set you up for a lot of mistakes in retirement. I've seen it for 15 years. So here's a couple things. What can you do to preserve your retirement? I'm going to give everybody a couple strategies here that you can implement to start taking advantage of this next 4 or 5 year window. And once again, I'm going to remind you again, if you need guidance on this, put it down at the end of this workshop. Write us a book. Honestly, the more detailed you can get when that survey pops up on all the different pieces that are either confusing to you, you want some clarity on, you want help, write it down so one of our network representatives knows how to help you at this, okay? Because I know this is going to spark a lot of questions. Taxes are so confusing, right? But let me give you a couple strategies you can implement and some things to think about at a high level. So tax efficient strategies, what are they? Well, number one, let's go back to what's taxable, what's tax deferred, and what's tax free. So the first thing you need to do from a strategic perspective is throw it all on the table and figure out where they go in each bucket. And by the way, this is something that we help with at MyFit University to be able to help you understand this. We have a really nice software that lays this all out. That's no cost to anybody that attends these. So what's taxable? We just talked about that. Your taxable income is going to be your pension distribution. Your FERS or your CSRS or annuity is going to be fully taxable, right? It could be Social Security is going to go into your taxable income category. If you have real estate, if you have investments that are going to pay you a taxable income, okay? Then you have these things that are tax deferred. Tax deferred is what we were just talking about, right? Your traditional TSP, your traditional IRAs. These are things that you have contributed to that's allowed you to defer on those taxes your whole career, okay? So those are important things to know because everything that is tax deferred is going to go back into that taxable income bucket when you take distributions. And then you have income tax free. Now, what falls into tax free retirement? There are three ways to create tax free retirement. Number one are Roth accounts, Roth IRAs, Roth TSPs. Okay, anything Roth is a tax free retirement, not only for you, but for your heirs as well. Anybody that's inheriting a Roth IRA, Roth TSP, they are also going to inherit that tax-free, okay? Versus we talked about before, is when you pass away and you have a traditional TSP, that is a fully taxable liability to your family when you pass away. Now, the other way to create a tax-free retirement is municipal bonds. You can go through and U.S. Treasuries and municipal bonds. Those things are all tax-free because they're borrowing from the government. The third way, which I think is probably one of the most important ways, and very few people know how to do this, is using cash value life insurance. Regardless of what you hear about cash value life insurance, is actually one of the only ways to create an income tax-free in retirement, because cash value life insurance, when you borrow from it, is tax-free. So a lot of people use that to create a tax-free income if maybe they make too much money to participate in a Roth, maybe they make too much money to do Roth conversions. There's a lot of different ways to do it, but again, you need to know what's available to you. So let's talk about what's available to you as a federal employee. This thing is a Roth TSP. Now let's take a look at an example of somebody contributing, a federal employee contributing to the Roth, and why this could really help you. Now, there are times when you as a federal employee can take advantage of both the traditional and the Roth, because here's the thing, traditional TSP, when you're making contributions to it, allow you to defer, right? We talked about that, but also lower your tax liabilities while you're working. So if you're making $100,000 a year and you're putting $10,000 into your TSP traditional, your adjusted gross income, what you actually pay tax on, is actually $90,000 instead of the 100. It's great, right? It allows you to take advantage of lowering your tax liabilities. But what if you could have the best of both worlds? Here's an example of a federal employee who is a single filer with $70,000 in gross income. Standard deduction was $15,000, right? Easy numbers. $55,000 of taxable income, right? So if you look at the brackets, that single filer making $55,000 of taxable income puts them in a 22% tax bracket, because it goes from 48,000 up to 103,000, you can see on the screen, right? So that's that person, even though they took the standard deduction, still in a 22% tax bracket. Now, they put in $10,000 into their TSP. Now their total taxable income is 45,000. Well, what did that do? That put this federal employee into a 12% tax bracket. It took your tax liabilities down 10% by contributing to the traditional TSP. Now, this person has around $3,000 of wiggle room before they go back to the 22% tax bracket. So in this situation, this federal employee could put $7,000 into their traditional TSP and $3,000 into their Roth TSP and get the best of all worlds. You can create a tax-free retirement while also lowering your tax liabilities of 10% while you're working. What an incredible opportunity. Most people have no idea how to calculate this. Most people just say, wow, this Roth thing sounds so great, and they dive headfirst into it, not knowing, look what would have happened. If you would have said, man, this Roth thing, I want to build a tax-free retirement, and you went 100% into Roth, guess what happened? That $10,000 that you contributed to TSP, if you contributed all that to Roth and didn't break it up like this, you would have kept yourself into a 22% tax bracket and never had got the opportunity to go down to a 12. It's why it is so important to work with somebody that knows how to run your numbers, to give you the guidance on this, because I see so many mistakes. Look, my job when I teach these workshops is to steer around a lot of the potholes a lot of other federal employees ran through. They popped a lot of tires along the way, right? And our job is to help steer you around a lot of the mistakes people make. This is one of them. So from a strategy perspective, I told you I'm gonna give you a couple strategies. This is the first thing you need to look at, know how to implement, and know where your numbers lie. Now, with these standard deductions going up like crazy, this could give you an even bigger opportunity to take advantage of these, and we want to help you work those numbers so you know exactly what to expect. So again, if understanding how much Roth you could do is concern for you, put it down and let us know so we know how to help you with that and run your numbers. Okay. Now, here's another thing that you've heard me, and I've alluded to this several times as we've gone through this workshop, is this thing called a Roth conversion. Now, I got to tell you, we do a lot of workshops around tax planning and Roth conversion. This is the number one strategy that we get asked at our firm how to do all the time. Because, like I said before, I know a lot of you may not have had the opportunity to do a lot of Roth while you were working for the federal government. A lot of you are in traditional, and that's fine. But here's your opportunity now. And these this 4 years of these really big bonuses in our tax law is where you should focus on this. Okay, this is huge for all of you. This is the opportunity to take traditional TSP, traditional IRAs, and begin to convert that money over to a Roth IRA. Now, there's so much that goes into that. However, here's a couple things you need to know. Roth conversions are different than Roth contributions. Some of you, when working for the federal government, you don't have an income restriction on what you can do for a Roth contribution to your TSP. On the outside, you have limitations. You can't put in more than $8,000. If you make too much money, you can't even participate in a Roth IRA on the outside. However, when you are doing Roth conversions, not contributions, conversions, there is no limit to how much you can convert. We have clients converting $10,000. We have clients converting $100,000 a year. There is no limit. Now, when you do that, you are going to create a taxable event for yourself, right? Any money that gets converted is also going to be subject to full taxation, every penny of it. That needs to be built into your plan. So why is that important? Well, if you do Roth conversions inside TSP, which they don't allow that right now, so if those of you getting ready to jump on Roth conversions inside TSP, you cannot do that inside your TSP today. Next year, they are potentially going to allow you to do that. Here's the problem. If you do a Roth conversion next year inside your TSP, I hope you have a lot of cash lying around because you will not be able to withhold the tax on that transaction. That's why most people probably won't do a conversion in their TSP. Now, most Roth conversions are done in the private sector because if you are moving money from a traditional TSP, traditional IRA, to a Roth IRA in the private sector, you can withhold on that transaction so you don't have to pay the tax out of pocket. Okay, this is an incredibly important strategy for most of you on this call. If you have 400,000 or more saved in your TSP, this is something that needs to be talked about. Now, I'm not saying if you have less than that, you shouldn't do this. But when you get to 400,000 and above, your tax strategies are a little bit different. And that's where you really need to put some emphasis on this. So if I was you and you have a question on this, put it down on the survey that's going to pop up and let us know this is a big topic for you want to talk about, and we'll be able to kind of guide you along the way and say, hey, listen, here's what it could look like. This is what it would be if you do this. This is how much you could convert each year. So important to know, because if you convert too much, you can put yourself into a way higher tax bracket. There are opportunities to convert money and stay in the same tax bracket, but this requires a lot of tax planning. If you're not talking about this, if you're doing it by yourself, understand the rules. If you're working with an advisor and they're not talking about this, to be honest with you, it should be a red flag, because this is huge for a lot of you, especially with this new tax bill. All right, so here's what you do. Get a complimentary tax review, okay? Part of what's gonna happen is at the very end of this, when that survey pops up, you're gonna have the ability to get your questions answered. Write a book for us. You're gonna be able to put down all the questions you have, and somebody from MyFit University will get back to you and answer all of your specific questions. Because what that's going to do is you need to look at this. Remember I told you to look at this like a puzzle. This is called comprehensive planning. Yes, we were talking about tax planning today, but there's so much more that goes into a comprehensive plan. It is tax efficient strategies, which we talked about today. How does it affect your legacy planning when it comes to estate planning? How does that affect your income? What about my investment strategies? How do they change when we're starting to be more tax efficient? When the strategy stops becoming about grow, 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 which we want to grow our money, how do we grow more tax efficient? How does it affect my healthcare? See, this is comprehensive planning. This is all inclusive, holistic planning. And most people that we work with, they have a plan. Most people just have an incomplete plan, meaning it's not encompassing all these different pieces. That's what you need to make sure you have to have, because all these come down to having a written income plan. It is, when will my paycheck start? Look, a lot of you are getting ready to retire, and you need to know, when is my paycheck going to start? How is it going to be taxed? Where will it come from, right? How long will my TSP last for? What's going to happen if I'm withdrawing money and the market goes down? How could it grow over time? How could it be there forever? These are questions that we get. We want to help out. So all of you that are attending today will have the opportunity to get a comprehensive written income plan up as part of, the benefit analysis you guys will all get. So again, tell us what your questions are. Be as specific as possible. It helps us help you, okay? So the survey is going to pop up at the end shortly here. Let us know how we can help. Thank you so much for attending. We look forward to helping you work with you in the future. Take care, everybody.